Hi, my name is Azin Shazik, and before we proceed, make sure you scan this QR code and download the Excel file as a reference. Now let's proceed with financial analysis. From the analysis that we have carried out, the result shows that FNN has an impressive efficiency in handling its asset and maintaining acceptable debt level. The company has sufficient level of liquid asset and capable of paying its short-term debt with ease. The opinion is also supported by an article from Simply Wall Street where it mentioned that the company does not have a heavy debt load. Moving on to leverage ratio, FNN has an outstanding reputation in local credit rating. According to article by Malay Mail, RAM reaffirms FNN capital debt facilities rating. It mentioned that the rating is based on the performance of FNN holdings, which largely within the RAM expectation. Furthermore, the company's debt to equity ratio also shows a steadily increasing performance over the recent 5 years. This might be because of the consistency of FNN in repaying its debt, which can be seen in the company's statement of cash flows. Next, we move to efficiency ratio. In terms of account receivable turnover ratio, we can say that FNN is performing below average compared to industry in collecting its payment from receivable. For example, in year 2017, the company's account receivable jumped from 542 million to 620 million in just 1 year. Not only that, even their cash flow statement shows negative cash flow for collection of trade receivables. The company inventory turnover ratio is seen that to have lower ratio compared to industry for the year ended 2016 until 2017. One of the reasons that we could come out is because of the weakening price ringgit during the year. We strengthened our opinion based on the article from The Star, which in the article said FNN will continue to face a challenging operating environment this year, which is 2017, as a higher raw material price drags margin lower. Therefore, in this situation, it is a good strategy to have a lower inventory turnover, as the price is expected to increase. This opinion is supported by the same article which mentioned it noted that the company has hedged a milk powder priced at the low for financial year 2017, with most of the US dollar requirement for the raw material purchases. Now we move to profitability ratio. The company return on sale fluctuate between years and is below industry average performance. This might indicate the company has high operating costs. One of the reasons that we can relate is the company has been incurring high marketing expenses. An article by the Marketing Interactive which mentioned FNN holding decline in operating profit due to high marketing spending and packaging material costs. Not only that, due to tax sugar implemented by Malaysia government, it significantly increased the cost of raw material as sugar makes up to 20 to 30% of FNN raw material according to MIDF research. From the graph, we can see that the company has lower return on equity compared to industry average. One of the reasons is because the company has high proportion of equity compared to liability, while within the industry, some competitor is majorly financed by debt, which resulting the ratio of profit to equity seems to be more favorable. Another reason is FNN equity is highly dilute compared to another competitor within the industry. For example, Nestle has distinct number of ordinary share compared to FNN. And finally, we reach to the last ratio, which is the market value ratio. FNN dividend per share has been stagnant over the years until the recent financial year, which is 2019. The dividend increased to 60 cents per share compared to 57.5 cents per share. One of the reasons is because the company has been steadily generate sufficient cash flow each year to pay out to its shareholders. This opinion is based on article Ian Tai, and looking at the company recent years cash flow statement is assuring that the company's capabilities in paying dividends. FNN earnings per share has been fluctuate over the years, which is due to inconsistent profit for the year. One of the reasons surely because of the above expected cost of materials. Since the company is the industry of food and beverage, it is crucial for them to strategically plan in order to get economic quantity order to maximize their profit. Therefore, it is hard to attain the same level of profitability each year, and the company might face some other challenges such as uptrends in commodity price that is essential to their production. And with that, thank you.